The hearing of this morning will reconvene. I apologize. A Democratic caucus was scheduled at the same time. I regret that more of our colleagues won't hear our witnesses, but it will be on C-SPAN. There is nothing competing with it in the floor of the House, and obviously the testimony will be available. It's a subject of continuing importance, I think, as a result of this morning's hearing and the conversations we had, particularly with the Secretary of the Treasury, that this question of what more to do with regard to mortgage foreclosure is very much an open question. And so this testimony will be especially relevant in helping us shape what I think is going to be the next step. And with that, we will begin in alphabetical order with Dr. Alan Blinder, who is a professor of economics and co-director of the Center for Economic Policy Studies at Princeton and a former vice chair of the Federal Reserve Board of Governors. Mr. Blinder.
Thank you, Mr. Chairman and members of the committee. And thank you for the opportunity to testify here this afternoon. I've come here neither to praise the TARP nor to bury it, but rather to urge Congress to exercise its oversight authority to ensure that the Secretary of the Treasury pursues the stated goals of the legislation. Failing that, I think Congress should take the Secretary's checkbook away and wait for a new Secretary of the Treasury. I noted that the Secretary said he's probably not going to ask for the second $350 billion anyway, so that may be moot. Mr. Chairman, I think you'll remember that I was among the earliest voices calling for something akin to, not exactly the same as, the TARP. Specifically, I recommended the establishment of two new institutions, one of which would purchase and refinance imperiled mortgages, and the other of which would buy up some of what we now call troubled assets, mortgage-backed securities, and the like. The TARP was, in fact, established to serve both of those purposes. They're in the legislation. So it's with great dismay that I look at what's been done to date and conclude that the TARP is not, in fact, performing its legislatively mandated duties. I object to the decision Secretary Paulson has made on at least three different levels. First, the choices he has made regarding how to deploy the money. Second, the execution of those choices. And third, what seems to me, although you, ladies and gentlemen, should judge that better than I, to be a pretty sharp deviation from congressional intent. So let me take them up in turn, starting with the last. Because the financial crisis has grown to be so complicated and multifaceted, it's worth remembering that it all began with falling house prices and defaults on mortgages, or to be more precise, fears that defaults on mortgages would become rampant. Foreclosures are personally painful and economically costly. They undermine property values, and they lead to fire sales of homes, which further depress house prices, thereby contributing to the vicious circle. It's difficult for me to see a way out of this mess without reducing foreclosures sharply. Understanding that, Congress wrote legislation that at numerous points exhorts, encourages, and even, I think, directs the Secretary of the Treasury to use TARP funds, at least some of them, to acquire mortgages and get them refinanced. But as you all know, he has not done so, nor has he purchased any of these so-called troubled assets, and has now recently said he does not intend to do so. The law that you passed in early October, authorizes establishment of the TARP to purchase troubled assets, which are defined in Section 3.9. If you have my testimony, the words are pulled out on page 3. But they basically say, A, residential or commercial mortgages and any securities, obligations, or other instruments based on mortgages. And then there's Clause B, which says, and basically says any other instrument that the Secretary deems to be essential to promoting financial market stability. And it adds to that clause, but only upon transmittal of such determination in writing to the appropriate committees of Congress. I presume this is the appropriate, or at least one of the appropriate committees. So I think of that language as defining three eligible classes of assets for the TARP to purchase: mortgages, mortgage-related securities, and then there's that catch-all, anything else that the Secretary deems important to financial stability. Well, I guess I'm an old-fashioned believer in constitutional democracy, and I followed from a distance, you ladies and gentlemen right in the middle of it, a pretty rancorous congressional debate over the TARP. And I'm pretty sure that Congress believed it was authorizing $700 billion mainly for the first two of those purposes, buying and refinancing mortgages and purchasing mortgage-related securities. Instead, as you know, almost all the monies committed to date are for capital injections into banks, justified under that catch-all phrase, any other financial instrument. Were I a member of Congress, I'd be pretty unhappy about this turn of events. And in fact, as a taxpayer shouldering his share of the $700 billion burden, I am unhappy about this turn of events. To be sure, I'm not suggesting that Secretary Paulson has overstepped his legal authority by making capital injections. They are, in fact, justified by Section 3.9b. Nor do I question the wisdom of allocating some of the TARP monies to recapitalizing banks. But I think we need to pay attention to the scoreboard, which so far, at almost halftime, reads mortgages 0, mortgage-related assets 0, other 100%. I don't believe that such a lopsided allocation of the funds is the optimal use of the public's money. And to see why, I'd like to review very briefly the arguments that support each of these three alternative uses of the funds, starting with mortgages. As I mentioned a moment ago, the financial crisis began with mortgages and fears of foreclosures, so naturally the legislation directs the Secretary to use TARP funds to get mortgages refinanced. Unfortunately for the country, he has chosen not to do so, and the mortgage problem has festered and worsened. Second, mortgage-related securities. Three main arguments were used to support the idea of buying these kinds of assets, an idea, as you'll remember, that was very controversial. First, panic had virtually shut down the MBS, mortgage-backed securities, MBS markets, which had to be put back in working order to restore our mortgage finance system. Second, one of the reasons for the panic, not the only one, was that nobody knew what these mortgage-related securities were actually worth, and a functioning market would at least establish objective values. Third, and importantly, many mortgages are tied up in complicated securitizations, so buying some of those securities would enable the government to get control of these captive mortgages and refinance them. In fact, that third objective was written explicitly into the law in several places, prominently in Section 109. Third purpose, recapitalizing banks, or more precisely, that catch-all, any other financial instrument. That was a wise addition to the Act because it gave the Secretary much-needed flexibility to respond to unforeseen circumstances. And I believe Secretary Paulson was right to decide that bolstering weak bank balance sheets was, quote, this is the phrase in the law, necessary to promote financial market stability. But this circumstance was hardly unforeseen. It makes one wonder why it wasn't written into the legislation. I would also question whether capital injections are the most appropriate, let alone the only appropriate use of the TARP money. And I have serious questions about the details of the program, which I'll come to in a moment. So was this a case of bait and switch? Secretary Paulson has appealed to the well-known Keynesian dictum that reasonable people can change their minds when the facts change. And there's no doubt that lots of facts have changed since October 3rd. But he has not, to my knowledge, explained what new facts invalidate the three arguments that I just gave and that were given in the congressional debate. Foreclosures are still coming en masse, and they still destroy value. The MBS markets are still in ruins. Furthermore, there's a natural symbiosis between buying up mortgages and buying up troubled assets. Purchasing the MBS helps the government acquire the mortgages to finance, mortgages that were otherwise buried in securitizations. And refinancing mortgages to avert foreclosures should enhance the values of mortgage-backed securities. And by the way, each of those should also bolster the financial positions of the banks, which of course is the purpose of capital injections. So I conclude that the arguments for buying both mortgages and mortgage-related securities still stand as they did on the day Congress passed the legislation, and I think it's a shame that neither of these is being done. But even given the decision to devote virtually all of the first $350 billion tranche of TARP money to capital injections, taxpayers might reasonably have expected a better designed program. I would fault the Treasury's execution on at least 6 dimensions. First, the program is enshrouded in too much secrecy. Second, Secretary Paulson decided to purchase preferred stock with no voting or other control rights, so the government winds up providing money while acquiring virtually no influence over the recipient bank's behavior. Third, taxpayers will receive only a 5% dividend rate on their preferred stock investments. Warren Buffett got 10% on a similar investment with Goldman Sachs. Fourth, participating banks are allowed to continue to pay dividends to their shareholders, which I found amazing. It raises the spectacle of banks borrowing money, cheaply by the way, from the taxpayers in order to maintain dividends to the common stockholders. Fifth, contrary to many suggestions, Secretary Paulson did not require participating banks to raise private capital pari passu with the government's capital injections, which I, among many, thought would have been a good idea because it at least would have provided a valuable market test of the viability of the institution. Sixth, the capital injections are being made with no, I repeat, no public purpose quid pro quo at all, such as, for example, some minimum lending requirements or maybe a pledge to refinance more mortgages. So the question is, why make the terms so favorable to banks and by inference so unfavorable to taxpayers? Based on what Secretary Paulson has said, I can only presume that he wanted to ensure the widest possible bank participation by avoiding stigma. Indeed, to this end, as you know, he even forced the money on several unwilling banks at that famous October 13th meeting at the Treasury. Excuse me? 1 more minute? Okay. So to put it mildly, the anti-stigma strategy didn't work. Within minutes, the big banks that didn't want or need the Treasury's capital made that fact known to the markets, and more banks continue to do so daily. And of course, that's exactly what we should have expected. It is in the interest of the healthy banks to demonstrate their health by saying we don't need this money. But by forcing it on recipients who don't need it, the TARP is wasting a precious, what to me is a precious resource, taxpayer money. So where do we go from here? First, I think there's not been sufficient oversight over the TARP's choices and operations. That's probably nobody's fault. It's hard to get organized that fast. And I'm glad to see the Congressional Oversight Panel is at least in sight, although not yet operating. Second, as I said, I question whether zero allocations of funds to buying and financing mortgages and to buying MBS is really consistent with either the spirit or the letter of the law. I don't think it is. Thirdly, despite that, one might ask whether Secretary...
We'll have to wrap it up.
Okay. Paulson, finish the sentence? One might ask whether Secretary Paulson's decisions to date have actually advanced the objectives of the law better than the law itself. I don't think they have. Thank you.
And next, Professor Martin Feldstein, former chairman, I believe, of the Council of Economic Advisors, and my classmate. So, Dr. Feldstein.
Thank you, Mr. Chairman, fellow classmate. I'm very worried about the U.S. economy. I think this financial crisis and the economic downturn are mutually reinforcing, and that without further action from the Congress, this recession is likely to be longer and more damaging than any that we've seen since the 1930s. The fundamental cause was the underpricing of risk and the creation of excess leverage, but the primary condition that now threatens the economy is the expectation that house prices will continue to decline, leading to more defaults and foreclosures. And those foreclosures put more houses on the market, driving house prices down further. This potential downward spiral reflects the fact that the United States, unlike every other country in the world, home mortgages are no-recourse loans. If someone stops paying his mortgage, the creditor can take the home but cannot take other assets or look to the individual's income to make up any unpaid balance. This no-recourse feature gives individuals whose mortgages exceed the value of their homes an incentive to default and to rent until house prices stop falling. Because the number of defaults is now rising rapidly and expected to go on increasing, Financial institutions cannot value mortgage-backed securities with any confidence. That's what stops interbank lending and lending by financial institutions that cannot judge the value of their own capital. The actions, I think, of the Federal Reserve and the FDIC have done a lot to prevent a runoff of funds from the banks and from the money market mutual funds, and to maintain the commercial paper market. In contrast, I believe that the TARP itself has not done anything to resolve the basic problem of the financial sector. The Treasury's original plan to buy impaired loans as a way of cleaning the bank's balance sheet simply couldn't work. Even $700 billion is not enough to deal with more than $2 trillion of negative equity mortgages. The plan to buy impaired assets by reverse auction couldn't work because of the enormous diversity of those securities. And even if the Treasury had succeeded in removing all of the toxic assets from the bank's portfolios, that would have done nothing to stop the flow of new impaired mortgages and the fear of more such toxic assets in the future. It was good that the Treasury abandoned this asset purchase plan. Injecting capital into selected banks is also not a way to resolve the problem and get lending going again. A bank like Citigroup has a balance sheet of $2 trillion. Injecting $25 billion of government capital does not provide a significant amount of loanable funds, nor does it give anyone confidence that Citi would have enough capital to cover any potential losses on its mortgage-backed assets. Although it does raise Citi's Tier 1 capital, that was not a binding constraint. So it was good that the Treasury abandoned the equity infusion plan as well. Last week, Secretary Paulson announced that he'll now concentrate on propping up credit for student loans, auto loans, and credit cards. He didn't say how that would be done, but doing so will not stop the lack of confidence caused by the expected continuing meltdown of mortgage-backed securities that is driven by the process of defaults and foreclosures. In light of this poor record, the Treasury's announcement yesterday that it will not seek any of the remaining $350 billion of original $700 billion TARP funding seems to me to be quite appropriate. What needs to be done? Stopping the financial crisis and getting credit flowing again requires ending the spiral of mortgage foreclosures and the expectation of very deep further house price declines. To do that, I think, requires two separate new programs, one for homeowners with positive equity and another for homeowners with negative equity. Here, briefly, is a possible way of dealing with each of these two groups. Consider first the problem of stopping homeowners who have positive equity from falling into negative equity as house prices decline to the pre-bubble level. Earlier this year, I suggested that the government offer all homeowners the opportunity to substitute a loan with a very attractive low interest rate, but with full recourse for 20% of the homeowner's existing mortgage. This mortgage replacement loan from the government would establish a firewall so that house prices would have to fall more than 20% before someone who now has positive equity would decline into negative equity. The key to preventing further defaults and foreclosures among the current negative equity homeowners is to shift those mortgages into loans with full recourse, allowing the creditor to take other assets or a fraction of wages if the homeowner defaults, as banks and other creditors do in Canada, in Britain, and indeed in every other country in the world. But the offer of a low interest rate loan is not enough to induce a homeowner with a substantial negative equity to forego the opportunity to default and thus escape his existing debt. Substituting a full recourse loan requires the inducement of a substantial write-down in the outstanding loan balance. Creditors now do have an incentive to accept some write-down in exchange for the much greater security of a full recourse loan. The government could bridge the gap between the maximum write-down that the creditor would accept and the minimum write-down that the homeowner requires to give up his current right to walk away from his debt. And I described this plan in some more detail in an op-ed piece in today's Wall Street Journal that's attached to the written testimony. If these two programs are enacted, the financial sector would be stable and credit would again begin to flow. But while that is a necessary condition for getting the overall economy expanding again, I'm afraid it's not sufficient. To achieve economic recovery, the nation also needs a program of government spending for at least the next 2 years to offset the very large decline in consumer spending and in business investment. To be successful, it must be big, quick, and targeted at increasing production and employment. I am, as you know, a fiscal conservative. I generally oppose increased government spending and increased fiscal deficit. But I'm afraid that that is now the only way to increase overall national spending and to reverse the country's economic downturn. If these two things are done, that is stopping the incentive to default on home mortgages and increasing government spending, I'll be much more optimistic about the ability of the economy to begin expanding before the end of next year. Thank you, Mr. Chairman.
Thank you both. Let me ask Mr. Feldstein, the 20% swap, you do say that everybody's now got the right to prepay. Are we clear that there are no restrictions on prepayment in anybody's mortgage?
No, what I would suggest is that if you go that route, the legislation provide that individuals have the right to prepay.
In abrogation of existing contracts?
To that extent. So, but I can't believe that there are going to be many creditors who would find that an unattractive.
That had been a problem, but just because you say since individuals now have the right to prepay and they don't, I mean, that's.
I don't think, did I say that?
Somebody else said that?
I don't think so.
Yeah, it's in your testimony. Well, not important, but it was on the March 7th. I'm sorry, it's in the March 7th piece.
Oh, yes.
At the bottom.
Well, I've learned some things.
Well, no, but it was true. In fairness, it was true that under the Hope Now program, they did get a waiver of prepayment. It wasn't legally binding, but
so I would say that they would have should be given the right to prepay.
What about with recourse? What does this do with second mortgages, which has turned out to be one of our problems in trying to resolve things? And I say this in the spirit of cooperation. I welcome these cooperative things. Yeah. What about the second mortgage issue?
I think that has to be done in proportion. In other words,
get their share.
They would share in this same thing. I would want to see.
And I appreciate it. I think we undercompensated them in the hope for homeowners, and that's one of the things that I hope we'll get result.
Well, it's clear you're not getting the take-up in the hope for homeowners.
There are several things. In fact, one of the things I hope they would do with the TARP would be to, if we were redoing Hope for Homeowners, we would learn some things, we would do it differently. Some things could be done administratively. Some would require a statutory change. But if they did it out of the TARP, they could, in fact, make those changes. But let me just get to the problem we've got, which was the $156 billion figure. That's for the people underwater. That would have to be regular spending.
Real money.
Yeah. All right, one of the things we are trying to deal with, and it's helpful to have two economists who don't obviously share the same ideological position make the point, because we run into a lot of resistance from people saying none of my tax dollars go to help people elsewhere. Now, you do, to some extent, respond to that with offering the 20% repurchase to everybody. So all homeowners, if this was packaged, could get some advantage. But the $156 billion at this point appears to be a large chunk. Let me ask, and I welcome, obviously, your testimony about the need for stimulus, and I think you talked about $300 billion. Is that in addition to the 156, or would that be part of the 300?
The 300, I think, is a number that, in fact, is a kind of minimal number, and it would be required not just for the coming 12 months, but probably for the 12 months after that.
So that doesn't include the 156?
And it doesn't include the 156. The 156 is not going to have a significant stimulus impact.
It changes prevent things from getting worse is the issue.
Right. And to that extent, it helps every homeowner because it stops other home prices from being
It is yes, we have made that argument. It is a hard sell. One of the things that I said to Chairman Bernanke yesterday, and I will say it with all respect, is former colleague, counterfactuals buy you more in more academic discussions than they do politically. Harm avoided is rarely something on which you can run for re-election, and that affects, I'm afraid, some of my colleagues. So I wanted to just, because you've been following this very closely too, I know, the FDIC plan, would you modify it some? Let me put it this. The Secretary of the Treasury has said, in partial criticism of it, that he thinks the way it is, with us doing half of the, guaranteeing half the loss after if there's a redefault, that you could wind up with a fairly small benefit for some homeowner, and after 6 months, a disproportionately large one for the lender. A, do you think that's reasonable? B, is it reparable if it is?
Sorry.
That was addressed to me, right? It's reasonable. It's definitely reparable. One sentence, and then let me address the question you asked more specifically. I think at this stage, we have gone so far down the let the foreclosures rip road that I, for one, would be ready to board any train that's ready to leave the station. So I would certainly board the Sheila Bair train. I think it could be improved. One thing I don't like about it, this is in the context of being very favorable compared to what's going on with the TARP, my attitude, is that eligibility requires delinquency. And any plan that has that feature sort of incents people to stop paying on their mortgages. So I'd like the eligibility to depend on sorry, I couldn't hear you, Mr. Chairman.
No, I agree with that. And let me say this. Fortunately, sometimes we get into the legal habit of do we have to accept it or not accept it. The TARP is so written as to give, as we are now aware, a great deal of flexibility to the Secretary. The argument that there are this or that aspect of Sheila Bair's very creative plan, that she's been a real, very positive force here, needs modification, is simply an argument to modify it.
Absolutely.
Under the TARP, they could do that. So I take that as encouragement that, and in fact, there's nothing, it would be good to have two models. The Hope for Homeowners is a principal reduction model. The other is an interest reduction model, and they could both be made available depending on what is appropriate, with elements of Professor Feldstein's. I mean, the nice thing about the TARP, its weakness could be its strength in that it does allow for several approaches. The gentleman from Alabama. Oh, the gentleman from California.
Thank you. Let me ask a question of our two economists here, because one of the occurrences that we've listened to over and over again in this committee is the Federal Reserve coming up here and also Treasury secretaries and saying that there was a systemic risk to the economy because of the leveraging that was occurring in the system. And specifically, they were identifying the leveraging, which I guess got up to about 100 to 1 at a point with the GSEs, with Fannie Mae and Freddie Mac, doing what somebody described as arbitraging, but borrowing at one rate, and then I guess they borrowed about $1 billion, and then went out into the market and had $1.5 billion in these mortgage-backed securities in the portfolios. And as they described it, one of the consequences of this was that the financial system worldwide was relying heavily on the mortgage-backed securities, and I guess also the debt a lot of the banks were holding as part of their collateral, these instruments from Fannie and Freddie. So maybe one of the things we weren't thinking about at the time was that there was also all of this leveraging going on, not just in the institutions themselves. Maybe that got up to 100 to 1, but was also because it was collateral for loans, there was this additional leveraging that was leveraged into the system. And then along the way, there was a little bit of nudging from Congress to Fannie and Freddie in terms of the type of loans that they should be purchasing, the goals that they should have. And so as a consequence, Alt-A loans, and subprime loans. I mean, this was a place then that those who were writing those loans could get Fannie and Freddie to purchase them as they got near the end of the year especially, and needed to make that target. And so as they ended up buying those back into their portfolio, and that being 10% of the portfolio, the argument that I've seen is that 50% of their losses at one point were these Alt-A loans and subprime loans that they had repurchased. And so one of the questions was, we have tried creating a charter, we've tried giving direction to a quasi-governmental entity or a private entity, whatever, however we want to define Fannie and Freddie. But might it be wiser going forward for us to just let market principles play out rather than take a scheme like securitization through Fannie and Freddie and then disallow or prevent the regulator, in this case OFAO, because OFAO testified here maybe a month ago or so, the director of OFAO, he said if they had gotten the legislation that they wanted, which would have allowed them to regulate for systemic risk, they could have deleveraged the situation, forced more capital, and they felt that even as 16 months from today, if they could have gotten that authority, they could have deleveraged this problem and made it a lot less of a crisis for at least the GSEs, and that might have staved off. They said it would have staved off the GSE problem. Be that as it may, that's their opinion. I had carried legislation in 2005 that the Federal Reserve had asked for to try to give them the ability to regulate for systemic risk in this way. But that's the question I wanted to ask you, gentlemen. Do you think going forward that perhaps we should back off of the portfolio arrangement there that we have, or the leveraging arrangement, and look at simply market principles maybe in terms of the way that Fannie and Freddie would conduct itself in the future? Because I can see, going out 4 years, 5 years from now, as we get this thing resolved, that same dynamic occurring again, as long as
I think there's
have
a
that model.
built-in flaw in a system that provides a government guarantee, even if it's with a wink, a government guarantee for a for-profit corporation. And I think we've seen the adverse consequence of doing that. So I would hope that gradually over time that gets wound down. The economic studies of the effects of Fannie and Freddie in terms of helping the home mortgage market is that it lowers the cost of mortgages by a very small amount. And so for most individuals, the gain that comes from that is very small relative to what we now see was a major risk for the system as a whole. So my own view is the challenge going forward is to find a way to gradually reduce the role of Fannie and Freddie.
Thank you, Dr. Feldstein.
I don't entirely, I agree with part of what Dr. Feldstein just said, not entirely. If I could just suggest, Fannie and Freddie had their origins in the perceived need, and I don't think that was wrong, to create some securitizations, mortgage-backed securities, and so on. We gave them, in our wisdom, we the United States, this rather odd duck character. They were sort of private, once they got privatized, they were sort of private companies, but not quite private companies. I think that at the end of the day, they're now operated as nationalized industries, basically. Once we can get out from doing that, this is a case where we need to go to one extreme or the other. That is, make them public enterprises analogous to Ginnie Mae, so nobody questions, this is the government. And by the way, that's where public purpose, low-income housing, affordable housing would naturally go. Or you go to the other extreme, which is what I think you were suggesting, sir, which is you make them just private companies. And
they do the securitization, but they aren't leveraged, 100 to 1.
They have no line to the Treasury, and therefore they could never operate with the kind of leverage that Fannie and Freddie operate. They would have leverage, but not as much. Indeed, I can well imagine that at the end of the day we do both. That those are two very large institutions, and that out of the ruins of those institutions comes a new government enterprise, no ambiguity. It doesn't have shareholders to cater to. It's just a government enterprise on the one hand, and also maybe more than one purely private company that's in the securitization business with no line to the Treasury, no special privileges at all.
Let me make a
I think time has expired. The gentleman from Pennsylvania.
Thank you, Mr. Chairman. Dr. Feldstein, just one point that I wanted to get from you. You talk about no recourse in all mortgages, but in Pennsylvania we have a dual system. You sign a mortgage and you also sign a judgment note. And the judgment note stands for any monies not covered by the mortgage. So we have a very low default rate or foreclosure rate in Pennsylvania. Isn't that common in a lot of states that there is a judgment?
In general, it is not. In most states, it is pure no recourse. In some states, like California, the creditor has the choice between taking the property or going after other ways of collecting, but then the property is taken out of the potential sources of funds. So I think it's something like 75% of mortgages are strictly no recourse.
No recourse.
But the de facto practice in many other places is not to pursue the individuals.
Right, and in Pennsylvania, very seldom do I see any pursuit on the judgment.
Well, that's also true in Europe, in Canada, and elsewhere. The fact that they can pursue it is enough to discipline individuals to not default, and that avoids the foreclosure.
Right. Now, I'm rather enamored with your proposals, to tell you the truth. What I don't understand is this is something that will take weeks or several months to finally put in language, statutory language, and to persuade the American people and the Congress to pass something like this. Why isn't it advantageous, or is it advantageous, for us to remain in session, have these types of proposals, reduce them into legislation, so that at least with the new presidencies, we're prepared from day one to being able to act, as opposed to waiting around for a blind piece of legislation to appear, and then we're all forced to make an either-or selection, knowing full well there are many things we could add to the bill that would make it much more applicable to the situation.
I think that would be a good thing. I am very worried because of the state of the economy of saying, well, let's just wait until the new president is sworn in, till he builds his team, till everybody discovers where their office is and starts working. That gets you to March, and a lot of damage gets done between now and March.
So if you had your druthers, you would recommend
I keep you all working.
to the leadership that we stay in, or at least establish a committee, whether it's a special committee or whether it's this committee, to start drafting the legislation that would be in total by the time the new presidency takes his oath.
Of course, the president would want to have his input into, president-elect would want to have his input into that. But again, I assume he's going to name his economic team within a matter of days, and so there's no reason why they couldn't start working with the Congress on this well in advance of late January.
In a way, I'm sympathetic particularly to you, because I think I know your philosophical bent. And for you coming with a proposal like this and taking an argumentative position to hold to that proposal, I have great admiration for that. But it does set you up with a conflict with my friend from California, who believes that the market itself should be allowed to go forward. Why, being as free a marketeer as you are, why have you canceled out the market really being able to resolve this problem?
We have, because of the no recourse nature of loans, the market is not working as well as it should. Because of the mistakes that were made in extending excess credit during this past decade, allowing for very high loan-to-value ratios, I think we need to have some intervention to correct these problems.
Would this require a nationalization of real estate law, basically?
Certain features of it, Congress would have to override the existing contracts and existing state rules. But I think, again, I'm not a lawyer. I don't know how broad that would have to be. somehow I don't think these are major changes in real estate law. But for example, if an individual now pays down a piece of his mortgage, the typical practice is that that reduces the principal but not the monthly payments. So they end up paying off their mortgage sooner. Well, my 20% mortgage replacement loan is intended to reduce their mortgage payments by 20%. So the legislation would have to provide for that.
All right, thank you.
I would just think legally, if it was a voluntary decision by a homeowner to accept the 20% in return for recourse, there's no problem. I do think you would have a problem, though, abrogating existing contracts unless you had mutual consent. I mean, that would be the legal thing. But the substituting a recourse for non-recourse in return for the 20% swap could easily be done.
And similarly, for the negative equity group, substituting full recourse on the entire thing, again, for the reduction. But that's okay for them. The question is...
I think you'd have a hard time legally forcing it on others, but we'll see. The gentleman from Illinois.
Thank you, Mr. Chairman. Mr. Bleidner, you talked about in your statement that talking about that there had been zero purchases of the two asset classes, and it's just been capital injection into the banks. And you say, were I a member of Congress, I'd be pretty unhappy about this turn of events. In fact, as a taxpayer shouldering his share of the $700 billion burden, and I'm unhappy. But there's still, and I don't know if you were here for the prior panels. Well, one of them was a plan for the insurance, which was actually in the bill. What do you think of the insurance plan? Is this something that we should look at, which would then, the actual financial institutions would carry the burden for paying for the premiums?
I thought at the time, and I still think, I don't rule it out, but I thought at the time, and I still think that it's being a different direction, and given the complexities of starting from scratch, as I said before, I'd rather jump on the train that's leaving the station. I don't rule it out. The problem always with the insurance plan that was being debated back in September, and by the way, insurance aspects come into a lot of these plans, some aspect of insurance. But the problem with that one, it was too much like insuring the house after it had burned down. It's very hard to design an insurance plan for the catastrophes that have already happened. It's quite relevant to the ones that haven't happened yet, and probably has merit in that regard. But a lot of these plans, the plan that's the essence of Hope for Homeowners that passed this committee first and then passed the Congress back in July was to bring in FHA insurance to close the deal. So it was at its essence an insurance. The government was becoming an insurer. So it really was a first cousin to that idea. And so that's already in the law. I mean, if I was able to wave a magic wand here, which of course I'm not, I would take some of the TARP, I would make some amendments to the Hope for Homeowners to broaden it and enhance the eligibility. You need money for that. I take that from the TARP to finance it. And to your question, insurance is of the essence of that.
But we did pass the FHA reform, and we did put a lot of money into the housing bill, the $300 billion. Wasn't that to help with the FHA being able to raise their loan limits so that they would be able to participate in the market?
Yes, but Congress didn't actually put much money in it. That $300 billion was someone's estimate, might have been the staff of this committee, of the value of the mortgages that were hoped to be refinanced. The bill was carefully crafted, as I understand, the chairman's left the room, but other members of the committee are here, to get its CBO scoring down to zero, basically. So the actual budgetary expenditure was nil.
Okay. Well, with the insurance that was talked about today and was in the bill, was really to let us know what the value of these mortgage-backed securities, what the intrinsic value is, what the true value of them is. Is this important or not? I mean, we have not really addressed that issue, and that was really, the purchase was supposed to be the start of that we would know what these mortgage-backed securities were about.
It's very important and impossible to do as long as there remains this risk of continued defaults, driving foreclosures, driving house prices down further. So if you looked at an individual mortgage-backed security or even an individual mortgage, it's hard to know what that's worth if there's a risk that at some point in the future that's going to default. And that's what makes it so important.
But it seems like we can't solve the problem until we know what they're worth.
No, you have to stop the bleeding first, and then the market will put prices on it.
But if I may interrupt, I do agree that it's important to find out what these things are worth. And I may be one of 3 people left in America that thought the purchase of the troubled assets made sense. And one of the reasons is exactly the point you're raising. Get some semblance of a market going, and we might actually be able to put prices on these assets.
I don't think so. I think, of course, the Treasury can put a price on it. It can say, I'm prepared to pay X for mortgages, variable rate, adjustable rate mortgages in California issued in 2007. That'll be a price. But is it a price that private individuals would be prepared to trade at if they couldn't then hand it on to the government? I doubt it. I think because they don't know whether the foreclosure rate is going to double again in the next year and make those assets worth a lot less. So I think that's the underlying problem here. We don't know what the future foreclosures are going to be.
The gentleman from North Carolina.
Thank you, Mr. Chairman. Dr. Binder was clear that he would, as an interim proposition, endorse the FDIC proposal. I'm not sure we got on the record what Dr. Feldstein's attitude would. I'm assuming it would take a while to get the political will or whatever to move to your proposal. Would the FDIC proposal be at least a reasonable step to pursue in the interim?
Well, I tell you what I worry about with respect to the current version of the FDIC proposal. It would be very tempting for creditors to accept the terms, write down for people who are thinking about defaulting, write down the monthly mortgage payments so that they qualified, but knowing that at the end of 6 months the individual would default and the government would pick up the...
I understand you have reservations about the way it's drafted. I'm asking as an interim proposition between what we have now, which is nothing in this area, and the proposal that you have made, would some variation of that addressing some of the concerns that everybody has addressed,
well, I guess
be
the
a
question
step
is,
in the right direction?
Would it be as you said, something to do now as we move on to do other things? I think there's room for multiple things.
That's
or
fine.
Would it
that's all I was trying to...
political process?
And Dr. Binder, I'm not sure you are on record yet as whether you support the approach that Dr. Feldstein has laid out. Is that something that you would endorse?
I could in principle, but I come back to what I said before about trains that are leaving the station. I think it would take a long time to get from here to there.
I understand that, but you think it would be a good place to get to if we could get there?
Yeah, certainly. If you compare it to the status quo, it's a great place to get there.
All right. Now, can either one of you distinguished gentlemen explain to me what in the world Secretary Paulson is saying when he says that dealing with this mortgage situation is not important to stabilizing the financial system? You all have a clue what he's... I mean, he says this is this is not the purpose of what we passed. Can somebody, he couldn't explain it to me this morning. I'm trying to find somebody who can explain to me what in the world he's saying.
Well, I'm baffled by that, frankly.
Okay, so you can't explain it. What about
No,
you?
if I could just one more sentence.
Oh, all right.
In preparing to come to this testimony, I scanned through the act, and there must be 15 places or something like that in
Well,
the
the chairman was good at pointing those out to him,
that addresses the
which
Secretary
makes
of
it
the
even
Treasury
more
to this
baffling.
problem.
Explain it to me, Dr. Feldstein.
I'm afraid I cannot.
Okay, I don't have any further questions, then I'll yield back.
Having stumped the experts, the gentleman from North Carolina retires in triumph, and the gentleman from Alabama is recognized for 5 minutes. Let me just say to my colleagues, they're about to start the votes. I think we'll be able to get all 3 questions in, and then we can go over and vote in the caucus. I appreciate it. Gentleman from Alabama.
Dr. Feldstein, you're opposed to taxpayer money being used to bail out or to loan to GM and Chrysler. Is that correct?
My first choice would be that they go through Chapter 11. My second choice would be that any money that's given to them be given under the kind of conditions that would make them long-term viable, which to me means a rewriting of the labor contracts, the fringe benefits, the retiree benefits.
Right. And I think if some concessions by the union management and maybe the pension funds, would those be the 3 parties who would have to?
Exactly. And I think those, if the alternative to getting money and making those concessions was not getting money and going to a bankruptcy court, they might well be willing to make the kind of concessions that would make those companies viable.
You know, and without any assurance that they would become competitively viable, any loan would actually be very risky. And, so I agree with you totally. Mortgage foreclosures. Let me ask you 3 or 4 things. The basic thing that I'm struggling with is mixed up with this issue of mortgage foreclosure mitigation is this idea of, quote, stabilizing housing prices. And I am very skeptical that the government, number one, can stabilize housing prices. And even if they could, that it would be beneficial. Now, I understand that preventing a foreclosure, you know, a house in a neighborhood diminishes housing values. But, you know, the reason we're coming down and housing prices are coming down is for decades, you loan money to people about 3 times their income. And then 10 or 15 years ago, we lost our way and we started loaning 4 and 5 and 6 times as much. And then the closing cost went from 2% to 5% to sometimes 15%. And these were loans that they simply, I mean, they couldn't afford these properties on their income. So is supporting housing prices even, is it realistic?
Housing prices have to fall further. So I don't think that the government should be trying to stabilize house prices at the current level. They overshot on the way up. They've come partly down. They have to come down further. The danger is that they can way overshoot on the way down. And that would be a bad thing. That would destroy financial institutions that are holding mortgage-backed securities. It would destroy household wealth, which in turn would make people cut back on their spending. And that in turn would drag the economy down. So the ideal thing would be to see house prices come down to a sustainable level, but not overshoot on the way down.
Right.
And that's why I talk about this firewall as a way of stopping house prices from falling beyond the amount that's necessary to get back to pre-bubble levels.
Dr. Belinda?
I agree with that. And one of the main arguments, to my mind, almost the main argument for pushing foreclosure mitigation is that you avoid or minimize anyway fire sales of houses, which do indeed, almost by definition, overshoot on the way down.
And
some
I
of
would,
that could be prevented.
And I would agree with that. You know, I think many of us conservatives, our dilemma is that we don't believe government ought to intervene into some of those natural processes. But at the same time, we do care about the communities, we care about the families, and we care about the fire sale and the implications for all involved. And it is a dilemma. One thing I would like to say, and I'm very glad that Dr. Feldstein, you said, and Dr. Blender, I think you agreed, and I've said for the last 2 or 3 months, putting a delinquency requirement in these different mortgage mitigation plans is the absolute wrong thing to do. I mean, people get delinquent. And I want to fully endorse, and I applaud you for taking that stand. Let me ask you this. What about the homeowner that's underwater? The house is worth $400,000 and he has a $600,000 mortgage. Now, in that case, it's best for him to walk away, is it not? And isn't that why a lot of these people are walking away?
Certainly in his interest now to walk away, but the proposal I described in today's Wall Street Journal op-ed piece tries to address what we could do for that person. Mm-hmm. And basically the idea would be to take that shortfall between what the house is worth and what he currently owes, and divide that, some of it being accepted by the creditor as a write-down, and some of it paid by the government to bridge the gap, but then requiring the individual to carry on with that mortgage as a full recourse mortgage, so that they wouldn't be able to walk away from it.
Okay.
Gentleman from Massachusetts.
Could he respond?
Thank you.
Well, quickly, if Mr. Bynum.
I was only going to say that's you took an example of something that is really deeply underwater,
Yeah.
and in cases like that, the best solution for everybody may just to be walk away. Most of the houses in America, thank goodness, are not that deeply underwater.
Thank you. Mr. Lynch.
Thank you, Mr. Chairman, and the ranking member. I want to thank both of the witnesses here for your thoughtful testimony. Dr. Blender, I do want to say that I think it's a double-edged sword, the fact that Secretary Paulson has said he's not going to ask for the other tranche of $350 billion. Instead, he's really, to use a football term, he's punted, basically, or fumbled, as another football term. But
I'm out.
He's basically telling us he's not going to ask for any more money. However, given our recent experience, I don't think we should take him at his word. Not because he doesn't mean it, but because we're having a crisis a week, and it may very well need to happen that he reaches out for more assistance.
Exactly.
One aspect of the problem that we're dealing with here is the fact that we've got somewhere in the area of $1.5–2 trillion in securitization pools. These mortgages are securitized, they're bundled. We've got some very complex CDOs. There's an opacity, a lack of transparency that is really causing problems with even ascertaining what the value of some of these instruments is. And to make matters worse, the banks don't want to lend to each other because nobody knows what the value of these CDOs are on each other's bank books. And because the CDOs, because they're not liquid anymore, no one wants to buy them, it's causing the assets within them and themselves within these banks to being written down. And it's causing a capitalization problem for the banks that are holding these. The problem for us is that we have seen some efforts so far to pluck, say, the lowest tranche, the equity tranche mortgages out of some of these CDOs. And because of the way they're structured and the agreements that govern them, we've had senior tranches or people with interest in the senior tranches basically stop that practice. How do we deal with this $1 to $2 trillion of securitized mortgages? How do we get at those in order to deal with homeowners who happen to be in that unhappy position?
Yeah, well, first let me say it's a very difficult problem and we're not going to solve it fully. Having said that, one of the ideas I mentioned in my testimony of the original conception of the TARP was to buy some of these assets MBS GDOs, whatever, get control of them inside the TARP. The government now would then be the controlling investor, and the government could then go in and pluck out mortgages and refinance them. I thought that was a good idea, actually. It's not being done.
There was I don't know if you saw it this weekend, Gretchen Morgenson had a column about two gentlemen, Thomas Patrick and Max Taylor, who have a pretty good plan to go in there. Have either of you have familiarity with that plan?
I read the article. I'm not a good enough lawyer to know exactly what's the right point of attack, but the basic principle is clear, that if the government becomes the beneficial investor, it then can restructure the mortgages and not worry about the others.
Right. Okay.
Now, you won't be able to do this for every single one of them, but we can do it for some.
Okay. Thank you both, gentlemen. I'll yield back the balance of my time.
The gentleman from the door.
Thank you, Mr. Chairman. This is for both of you. We've got to go, and I wanted to talk about situational conservatism, but we don't have time. Dr. Feldstein, I'm always concerned. I mean, it's always amusing that people are opposed to government involvement until they want government involvement. But that's not what I'm going to talk about because I don't have time. But the question I want to ask, do either of you find that there is something wrong with the fact that that the banks are able to borrow cheap money from the government? The loan rate, the lending rate between banks is still unstable, and at the same time, the consumers' borrowing costs seem to be rising. I mean, is there something, does that bother you, trouble you at all, particularly when you consider the fact that we're putting money into these lending institutions?
It does. I think that's part of the essence of the problem. The risk-free or virtually risk-free short-term interest rates are extremely low. The federal funds rate, as you know, is 1%, and in fact, it's trading at 0.25%. The LIBOR has come way down, although it's not very low by historic standard. The essence of getting out of this broader financial problem is to get the risk spreads that intervene between the risk-free rates and the rates that actual real borrowers have to pay down. That's in some sense the overall uber goal of the whole thing, the whole effort. The specific issue that does bother me, you started to allude to it in your question, Congressman, is the low rate that the taxpayer is receiving on the preferred stock that it's injecting into banks. It's a bargain rate.
Dr. Feldstein?
I think what Alan said is essentially correct. The fact that mortgage rates have not come down at all, even though the federal funds rate has come down to 1%, tells you how dysfunctional the credit markets are and how wide these risk spreads are. And until we get the financial institutions to a point where they're willing to buy long-term assets and take those kinds of risks, we're going to see this situation in which interest rates facing consumers are very high, despite the action by the Federal Reserve in bringing down the short-term rates.
Thank you. I wish we had more time. Thank you very much. Appreciate it.
Witnesses, I very much appreciate this. This has been very useful. As I said, this is ongoing, and we will be doing more. We are now, the Democrats, going to have to go vote in caucus, so closing the hearing, the ranking member had a statement he wanted to make, and he will close out the hearing.
Thank you, Mr. Chairman. Mr. Chairman, one thing going forward for the record, I want to say, in fact, you two gentlemen may be aware of this, as we address the foreclosure delinquencies and our foreclosures and mortgage delinquencies, that next year we'll face somewhere between 250 and 300,000 resets of mortgage interest rates. That's people that can pay the mortgages now but can't next year. And sometimes people hadn't factored that in. And as if that was not a problem, in the year 2010, we face approximately 700,000 of these, quote, I call them exploding mortgages. But and of all the planning we need to do, that's something that we need to factor into our plans going forward. And I don't know if you have a comment on that as we close, but.
I think you're 100% right. And from the get-go, when I first started writing about this problem in January, that was one of the problems on my mind and many other people's mind. And it's a prime argument for getting more of these mortgages refinanced so that the ticking time bomb doesn't actually blow up when the time comes. Yes, absolutely.
Dr. Feldstein?
I agree with that.
Yeah, it is one of the most disturbing challenges we face going forward in the housing market. Well, thank you very much for your attendance, and the committee is recessed.
Thank you.
Or adjourned, actually.